Hey, welcome back to the Victor H Investing live stream. This is a live stream just to look at this past week, look at how the stock market behaved this week, see if it was up or down and the reasons for it. I wanted to compare the different exchanges and just see where the market is rising and where the market is dropping. I also wanted to take a look at some stocks that look interesting to me because they either went up a lot or they dropped a lot. So I wanted to take a look at that, and of course, get any viewer requests to see which companies you'd like to talk about. It's great to have a couple people on. Bad Omen, thanks for joining. Appreciate it. Good to see you. And then Quag, very nice to see you. Happy Friday to you. It was a pretty good week this week. The S&P over the last 5 days was up 1.27. And overall, if we look at the year chart, this is what I'm nervous about. The market's just going up and up and up. And although that's great because our stocks continue to go up, we just need to have a couple of down periods, like a correction, just so that stock prices don't get too high. I'm not seeing a lot of good deals on stocks out there. And I suspect that it's because just we've been going up for a while. This is just in the last 6 months. If we look at really from the end of 2022, or I say October 2022 to this point, we're up 45%. So it's been a really good market for equity investors. And at some point, we got to see some downturn just so that the prices don't get too high. When we look at the S&P and compare it to, let's see if this is going to let me compare. So the Dow is doing well this week. And let's compare the NASDAQ. And then the Russell. So year to date, it looks like, the S&P is doing really well. The NASDAQ is right there with it. The Dow is at around 5%. That's kind of expected because the Dow is made up of stocks that are more, old stocks, old companies, pay a dividend. They don't move up really fast, but they don't fall a whole lot either. Then the Russell is lagging. I think you guys have heard me say comments around small and mid-sized companies are just not, their performance is not great. And it's showing up in that index. So that's year to date, but let's look at the month. So for the month, S&P is up 1.2. The Dow is up 2.73. And that's what I wanted to point out. So Dow companies are those old dividend payers. These are value stocks. And it looks like they performed well for the last month. The Russell 2000 did show up 1.55, but it's not like an incredible return. It's just a decent return for the last 30 days. So I'm seeing that, hey, maybe the big stocks are priced pretty high. We'll see what happens. But that's what I'm seeing in the market there. I continue to believe that we're due for a pretty good pullback correction. It'll happen at some point. We'll see when. All right, couple comments here. Bad Omen. I'm looking at Nike right now, thinking maybe getting a bit more, but at the same time, I'm thinking I might go down a little bit more. So I bought more Nike stock today. I'm buying Nike because I think it's discounted. I have a video on my channel. It's if you just go to the channel and then search for Nike, you'll see it. It's a full analysis, and I think that Nike was really sold off. Let's take a look at it really quick. So here's Nike over the 5-year chart. You see this sell-off here. Now, this is understandable that, hey, we had this boom after COVID, and it had to correct, and I agree. But over the last year, we've had this real strong pullback and real drop of 26%. And I took advantage of that. I started buying around this period here very recently. I'm up on the stock a little bit. And today was a down day, and I bought $500 more of Nike, and I think I bought yesterday as well. So Nike is a stock that I'm accumulating. I just think that Nike is discounted. And let's take a look at Nike, and I'll show you my evaluation. So Nike, I believe, and let me update the stock price. Stock price is $90.94. So I think it's still discounted by 25%, based on the free cash flows I expect the company is going to produce. And then when I look at the earnings per share, and Nike's a really good company, number one in their category. And, I'm not expecting to get a 50% discount on such an awesome company. So a 25% discount to me is a good opportunity to build a position, upwards of $40,000, $50,000 in Nike. So good question there. Quags, I've been saving cash like Buffett. Nice. I've been saving up some cash thinking, if the Oracle of Omaha, which is his nickname, is accumulating cash. And I think his complaint is that there's not a lot of good deals out there. And I agree with him that it's hard to find a really good value. All right, next question, Quags. Do you own any small cap ETFs? I don't. I don't really do ETFs right now. I was doing ETFs not too long ago. I think it's good for investors to look at ETFs, especially if it's maybe a sector or an industry that, hey, I want to have exposure to it, but I just don't want to spend the time, or I just don't have the expertise in that industry just yet. So I'm just going to go into that ETF. Great idea. But for me, I don't do ETFs. Small caps, I own small cap stocks. So I'm going to highlight one a little later that I'm going to review, and we'll go from there. All right. So Sergio, very good to see you, man. I saw your comment earlier on Hawaiian Electric. Hawaiian Electric industry stock price didn't change almost anything even after the earnings report. Yeah, let's take a look at it. And that's a good question. So Hawaiian Electric, if you recall, there was those I think the symbol is HE, right? Yeah. So if you recall the bad fires in Hawaii, I believe they may be involved, and there may be some massive lawsuit that affects them. And that's why we're seeing in their stock, we saw this big drop right here, is when they were implicated, their stock went from close to $40 a share down to 10. So that's a 75% drop in the stock price, because there's potentially a big lawsuit that, hey, you're going to have to pay for all these houses that burned, businesses that burned, and you have to basically pay for that business owner's loss of income. It's massive. So that's the first order of business, is how comfortable are you as an investor in looking at that? It's going to be too much of a liability to deal with, and how many years is it going to take? A particular case like that, or a situation like that, it's going to take 2 to 3 to 4 years. So this stock will be impacted by that situation. Now, specific to, they had their earnings report. We'll kind of take a look at that really quick. And net income of 42 million. They had earnings per share of 38 cents. Here's the mitigation and resilience efforts. I think that's where they're talking about, the wildfires. And where is it telling me about like their performance? So they have earnings per share is fine. So they did declare a dividend. So that's good. What's the dividend rate on it? So dividend is 7.2. That looks like a good dividend rate. And it's because the stock price dropped so much. See, it's already down to $9, and analysts are saying it's overpriced by 9.9%. It's a sell because there's a lot of trouble with it. And this is one situation where, I'm not a lawyer. I'm not a lawyer around this type of stuff. I have no idea if it's going to go their way or it's going to be really bad. So yeah, I could see that, their earnings were decent. They made money. They're going to declare that dividend. I'm sure their balance sheet's okay. But let's take a look at their balance sheet really quick to see if they're already doing, reserving losses, which companies tend to do. They're expecting that if that lawsuit happens, then they're going to have to pay out a lot of money. All right, so here is their investor website. Here's their earnings release. Okay. And see, here it is. They continue to work with the people that were affected by the Maui wildfires. So that's the number one issue they're going to have, or situation, as it should be. I mean, it was a huge fire. It affected a lot of people. They do have a cash dividend. And I think a utility, they're mandated to do it. It's not like they're not allowed. They're allowed to skip a dividend. I believe they're forced to do it. All right. So revenues are looking okay. They dropped a little bit. Okay. But they are profitable. Looks good. If we look at their balance sheet, they didn't put their balance sheet on here. See if they've already got their SEC filing on here. They do. All right. So we'll get their balance sheet in there for sure. Make this bigger. So every company has to report to the SEC, and they have to report their 10Qs every quarter for the first 3 quarters, and then a 10K represents the whole year. So K for the year, Q for the quarter. You get the fourth quarter with the 10K because it's the end of the year, and it also tells you about the quarter. So here's their balance sheet. So they have 485 of cash. Okay, that's fine. Okay, liabilities. And so I'm looking for a reserve in their liabilities. I'm not seeing it. I guess maybe the other, but I'm not quite sure. Where are they? Stating, all these lawsuits. What are they going to amount to? So I think that's what you're seeing in this stock, Sergio. Is all that litigation is going to be a cloud over this company for a long time. If you look at what happened with 3M, 3M had litigation. And they just finished it. And it was for like 2 years. It's just like on and on and on. A big, situation that just created a lot of bad news. You bought some calls and the price barely changed. Yeah. It'd be interesting to see what happens. But I think, the stock's going to follow the news. If there's good news around the litigation, stock's going to rise. If there's bad news, the stock can't go down any further. So we'll see what happens. All right. So bad omen. I have a question. Since you're an experienced investor, I know how you've been saying we are due for a correction at some point in the near future, but why do you buy stocks like Nike right now? Very good question. So no matter what market we're in, right? A market is made out of thousands of stocks. And it's not like when the stock market goes up 10%, every single stock goes up 10%. It doesn't work that way. In a market, you may think of it this way, is it's somewhat of a zero-sum game. As some industries and sectors move up, they're doing it by taking dollars away from other sectors. And the other sectors are being sold off by the market. I'll give you an example. Technology was doing great in 2023. along with communication services, which includes Alphabet, Meta, Netflix. Well, those investment dollars were taken away from healthcare companies, and you saw healthcare stocks go down. So healthcare stocks, I believe, are discounted because they were just discounted through all of 2023, and they so far this year are doing okay, but not great. So why am I buying stocks like Nike? Well, because Nike is showing that although I think I could probably show it to you here. So come on now. So am I comparing this? Give me a second here. So we got and this chart's not working for me right now. Let me start all over again. Okay, so we have two charts here. The S&P. The S&P is going up, right? Nike's going down. So they're going in opposite directions. So I'm buying Nike because I believe it's a great company and I believe it's discounted right now. Yeah, most stocks are overpriced right now, but I'm picking out the few companies that the market doesn't like for reasons that the market is selling off Nike. That's the market's reasons. I have reasons why I'm buying Nike stock. Okay. So that's the answer to your question there. Good question. Right. Bad omen. Wouldn't it be better for the market corrected by stock? Yeah. So here's what's hard. Okay. So I think you're asking is, wouldn't it be nice if the market really sells off and then it's clear to us that, hey, it's a really good time to buy? Here's the psychology of the market. When the market started selling off in 2022, it was like it sold off and then it rallied, saying, oh, okay, we had that correction. Let's get back to those, higher stock prices. And it kept going down. And we got to a certain point and investors really became fearful and desperate, like, oh my God, this market's never going to go up. And actually, when it gets super horrible is when you should be buying the most as a value investor. And it's very hard to, though, because you're getting down to, like, at this point, you were seeing stocks like Meta down like 80%. You're seeing Amazon down 70%. I mean, it can go on and on. And that's when psychologically and emotionally, it's the hardest time to buy, but it's the best time to buy, actually, if you look at how stocks will behave afterward, because you can see that, oh yeah, hindsight's 2020, it went up 45%. So when it really crashes and it really pulls back prices. So yes, it's a lot easier if you have a big crash and a correction. Once you get into high price zones, it's much harder. So that's why I'm being very careful just to pick and choose. I only bought 2 stocks today and 1 bond. I bought Nike and I bought Pfizer. And Pfizer, I believe, has been discounted as part of that category of healthcare stocks that I believe continue to be discounted. So good question, bad omen. Quag, would you mind looking at Manu? Let's take a look at Manu. Manchester United? Is this the football club? Wow, interesting. Look at that. All right. The stock really took off, looks like toward the end of 2022, and it's really come down a lot recently. Okay. So this is a $2.67 billion market cap. This is Manchester United, together with its subsidiaries, owns and operates professional sports team in United Kingdom. Okay. So it's one team, right? Or do they own multiple? Looks like they own that franchise. Okay, good. All right. So 2.67 billion, revenues of $900 million. Not too bad. You're paying 3 times revenue. They don't have a PE. They don't have a dividend. The analysts that do cover it say it's a buy and it's discounted by 33%. Looking at their financials, they've been growing in 22, 23. Their cash flow, operating cash flow, 95, CapEx, 171. Okay, negative cash flow. That's not good. Negative cash flow last year, negative cash flow the year before, negative cash flow the year before, barely positive cash flow in 19, negative cash flow, barely cash flow, barely cash flow. So I'm not loving the cash flow. I might respect that they're really cool, football club, but their cash flow does not look good. Cash, 76 million, and their debt, 515 plus 107, 622 million in debt. Okay. Not too bad. Their income is 45. Yeah. Yeah, I'm not liking their balance sheet because they're only making probably EBITDA of like 60 to 80 million dollars a year. It would take them roughly 6 to 7 years to pay off their debt if they wanted to pay it with EBITDA. They don't have a ton of cash. So I don't like their balance sheet. I hate their cash flow statement because they don't make any cash. There's another thing I don't like about stocks like these. It's Manchester United. So how many fans of this football club do you think, football club, I'm in the United States, apologize. How many fans do you think are buying this stock just because they're fans? It's an emotional buy. Hey, I'm going to buy stock. I think it's a good investment. Yeah, because you're thinking with your heart, not with your mind. So this is a stock that I just don't see how I can invest in it. So, all right. That was an interesting one because I haven't looked at a sports team like that. All right, Quags. You've been buying shares here and there. Okay. Well, at least I gave you my opinion without being influenced by your direction. And please, it's just my opinion. I could be totally wrong. All right. Yes, you know about the fires. Then you're talking about Hawaiian Electric. Yeah. Hey, Omar, thanks for showing up. Let's do Udemy. Thanks for showing up. Thanks for viewing my videos. I appreciate the comments that you put on my videos. Very appreciated. So this is a learning company. And so I own Chegg, and we're going to look at Udemy. Now, Chegg's similar, so I can compare it to Chegg. And these guys do a marketplace platform for learning skills in the United States and internationally. Okay, I get that. Market cap of 1.5 billion. They're really sold off. They were, in the 20s, and they really sold off and kind of stayed that way. All right. Looks like they IPO'd maybe 3 years ago or 2 years ago, roughly. Forward P is really high. It's a buy, and it's supposed to, analysts think that it's fairly discounted. The average is they're discounted by like 53%. When we look at their revenue, it's growing very good, going from 515, 630, 728. Okay, looks good. Balance sheet, they have cash and cash equivalents, 480 million. And we look at their debt. Long-term debt's $1 million. Very good. Current debt, $5 million. So they have no debt. They have no debt, and they have like close to $500 million of cash. Now, let's go back to their overview. So they have almost $500 million of cash, and their market cap is 1.5 billion. So it's a pretty good ratio there. It's almost like you're really the market cap, since you're getting 500 million in cash, the market cap should be more like 2 billion in my mind, but I'll show that to you later. Okay. So the financials look good. What about cash flow? All right. Cash flow, we're looking at operating cash flow in the negative. Okay. And then CapEx of minus 13. Okay. So they're not producing free cash flow, and that's a problem for me. Why are they not producing free cash flow? So revenue, gross profit. Okay. I'd want to get my head around free cash flow because I could tell you that this company is not worth a whole lot to me if they cannot produce free cash flow. And they've been around long enough to produce free cash flow. It shouldn't be, if you look at Chegg, and I'm going to keep this there for a minute. So here's Chegg. And if you look at Chegg's financials, and I'm going to say they're in the same kind of sector and industry. And if we look at Chegg's cash flow, 246 million in operating cash flow, 73 million of capex. So free cash flow is roughly $173 million for Chegg. 173 million. That's very good cash flow from a company that's producing $716 million. $716 million of revenue. Back to this company. They're doing about the same revenue, but they're not generating cash. You see the big difference, Omar? That's why I would favor Chegg, and that's why I'm a stockholder of Chegg. There's another big threat to Udemy and Chegg. Artificial intelligence. Is artificial intelligence going to be good enough where instead of going to this website where I'm like, okay, I'm going to take these lessons and learn these skills, is AI on, Google's platform, which is Gemini or ChatGPT? Am I going to go to those free services and get everything I need to learn whatever I want? Well, if that's the case, it's bad news for Udemy and Chegg. Okay. But I've looked at Chegg's strategy, and they're very busy investing in building their own AI app for students. And if they do that really well, they might be able to keep all their clientele and grow it and probably be more profitable and probably be more differentiated in the market. Because if students find out that, hey, if I want to do well in the exam, I go to Chegg, especially for the hard subjects, because they get it right. They're built for students to help me with my education. ChatGPT is for the whole world. It gets asked questions all over the place. And where Chegg is really focused on one use case, which is, services and information for the student that's learning. So those are my comments on that company. Thanks so much for your comments and your patience. I know that it's taken me a little while to review this company, and hopefully those comments were interesting to you. Neil. All right, Neil. I think it's their automatic tax on dividend. And I'm not sure where we're talking about that one, but thanks for the comment. Bad Omen. All right. Thank you for tuning in, man. Really appreciate it. All right. You're becoming a regular. The next one, cinematographers. Let's give Victor some likes. Oh, I appreciate it, man. You've become a regular. Great to have you. You, Quag, Sergio, Omar, all of you guys, man. Neil, thanks for watching the videos and providing comments. We lose connection. Can you guys hear me okay? Oh, okay, good. All right. Next one, AP. Thanks for tuning in, man. I think it's the first time I've interacted with you. Appreciate it. Bros. So is this Dutch Brothers? Yeah. So we looked at this one, I'm going to say 2 weeks ago. So let's take a look again. So it's a $6 billion company. Dutch Brothers has, it's more of a regional player that started in Oregon. I've been to a Dutch Brothers. I went to a Dutch Brothers like 10 years ago when they were smaller. So I was able to experience, kind of like the old school experience. It is nice. They obviously compete with Starbucks and other coffee retailers and coffee restaurants. So they're a $1 billion company, paying 6 times revenue. Their forward PE is a big 104. Okay. Buy rating, but it's only discounted by 1%. So Not overly excited about that. They've been growing, okay? And a company like this, right? They're less than $1 billion. Let's make sure let's start up Starbucks over here just to show you. Starbucks is 86 billion. So Starbucks is more than 86 times bigger than Dutch Brothers. So these guys can grow quite fast because they're so small. Growing when you're small is a different game than growing when you're already Starbucks and you're 86 billion. All right, so they're growing. That's good. And we'll take a look at their cash flow. So cash flow, operating cash flow 139, CapEx 227, negative, 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 barely positive. So negative cash flow. So some investors like investing in companies that are growing. And that's not my game. My game is I'm a value investor. I want to see positive cash flows, especially from a business that's in this industry, because these guys have to pay a lot of people hourly wages. They have to buy materials. They have to rent real estate. This is an expensive industry. Restaurants are expensive. You have to rent pricey real estate. You have to pay employees to serve customers. You're making money, $3 to $5 at a time when you sell it to your customer. And that's my opinion on Dutch Brothers. It wouldn't be a stock that I think I would value anywhere near their market cap because they don't produce free cash flows. All right. Super Loco Taco, good to see you again. Valley, I haven't seen this company in a while. I reviewed them 2 years ago. They were pretty interesting. They sell iron ore, and they I believe they do it down in Brazil. Got it. And let's see what their stock's been doing. It's been kind of going up, down, up, down, up, down. Look at that. Looks like a nice mountain range. The peaks are getting lower, so that's interesting. They're a $53 billion company. Revenue is about $41 billion, and forward PE is only 5. Incredible. Oh man, look at this dividend, 11%, phenomenal. It's a buy with a 34% discount. Interesting. These guys, I'm pretty sure they cash flow really well, and they're 17.2 capex 6. So you're doing about $11 billion of free cash flow. Are they growing? They're kind of contracting. These guys are really dependent on steel prices. If steel prices rise, these guys make money. Like in 21, steel prices were better. You can see some years where they really make a lot of money. Steel prices go down, they don't make as much revenue, and they lose money in some occasions. So it looks like 2023 wasn't too bad. I think materials companies are a pretty good play right now. I own a competing stock to them, and that's TX. And the reason I know of Val, it's either Val or Valet, is that these guys here, I thought were better for a couple reasons. Their market cap to revenue, you could see it's 8 billion in market cap, but their revenue is 17 billion. These guys, you got it the other way around, which is 53 billion, higher market cap than their revenue. These guys are strategically located primarily in Mexico. And I live in the United States, and I know that a lot of steel ends up in the United States in appliances, cars, all these products that Americans buy, as well as other people in Latin America. And I think having a company that is extracting iron ore from the region of Mexico, which they do have that as a natural resource, and then they have these foundries and mills where they're producing rolled steel, is a competitive advantage from a geographic standpoint. These guys also have some operations down in Argentina. Now, this company is interesting. Valley, it's just not an interesting stock to me because I'm already invested in TX. I think I have $45,000 invested in TX, and I'm good. TX pays a nice dividend. This company looks interesting that they produce free cash flow. They did about, they did about 11 billion in free cash. So if we multiply that times 15, that'd be about 150 billion. and they're only 53 billion. But we can't exactly price them out or value them that way because it's a materials company. They're not a growth company. It's a cyclical industry. Now, analysts are saying, hey, it's discounted. It should be priced 34% higher, and they may be right. Earnings per share looks good. It's going to stay relatively flat. So my opinion on Valley is if you're looking for a very high dividend payer and you're good with the risk down in Brazil, for me, it'd be out of the country. I'm willing to do that. I own, obviously, TX, which is headquartered in Luxembourg, operating in primarily Latin America, including Mexico. I have one investment in China and so forth. So this one looks interesting. It's certainly cash flow looks great. Valuation is going to value. I would pick the materials company that you like the most, that you believe in the most, that has the most strategic advantage. Good question. And I think materials companies are going to do well. Why? Because we've been in kind of like this economy where 2 years ago, maybe even 2.5 years ago, they were, the economists were saying, hey, we're going to have a recession. We're going to have a recession. They kept repeating it. And it was almost like Chicken Little, the sky is falling. It never fell. Well, the recession never came. We've had slow growth, but it's never been officially a recession. Well, that slow growth is enabled or has kind of kept demand down for a lot of durable products, appliances, cars, and so forth. And when those industries rebound, material prices will rise. Companies like Valley and TX are going to do really well. And I'm expecting latter part of 2024, 2025, I'm thinking that's going to be a rotation we're going to see. And we're going to see that the materials companies are going to begin to really rally. So we'll see. We'll see if I'm anywhere in that neighborhood of being right. All right. Random, thanks for joining. Appreciate you joining. Cinematographers, I believe, Manu is a swing trade. Potentially. Absolutely. Typo about V and Copa. V Copa. So let me try to go back to your earlier comment. Can you which stock did you want to see? Copa? Typo. How about V for Visa and then Copa? Okay. So Visa is like one of the most valuable companies on the stock market. And you see this chart, this is what investors dream about. Hey, I bought Visa at 160 and it's 280 and it's giving me few heart attacks along the way. And that's a very beautiful chart, considering that we had a huge pullback in stocks during this era and we had COVID, big, pandemic going on. So overall, this is a very valuable company that's very consistent. I've done my analysis on this company. The dividend isn't all that great. It's pretty low. And I think they're priced to be fairly priced. I'd be a Visa investor if we had a huge pullback, like stock market goes down 15%, 20%. We get back to an era of like 2022 where this stock was actually down around 40, 50%. Then I'd be a buyer of Visa. From a quality standpoint, Visa's as good as it gets. It's a very consistent company. The reason for it is everybody seems to have a Visa card, if not 2 or 3 in their wallet, and they pay for their stuff with a Visa, and Visa makes money on every transaction, literally. So that's my opinion on Visa. We can go through the valuation, but I could tell you it's just a really good company. They're growing, very good. Cash flow, they generate very good cash. So here's cash flow. 20 billion minus 1 billion, 19 billion. You're going to hear me say this over and over again. The most valuable companies on the stock market generate high amounts of free cash flow. Here's an example. 20 minus 1 is 19. And if you look at their valuation, this is a $561 billion company. This is probably a top 10 value company on the stock market. And it's because they generate that free cash. So that's Visa, and then Copa. I'm not familiar with Copa. Copa Holdings. Copa Holdings. Passenger and cargo services. So it's an airline. Interesting. So I'm in United. These guys are 4.3 billion, revenue of 3 billion, net income. They're profitable, very good. Forward P is really good. Good dividend of 4%. Strong buy, discounted by 40%. So these guys are doing flights in North, Central, South America, as well as the Caribbean. Very interesting. So again, I own United. It's kind of a company that I know of. These guys are growing really well. Cash flow. Operating cash flow 1.1 billion, capex 566. They're producing about, call it $550 million of free cash flow. Last year, free cash flow, year before, free cash flow. So this is going to price out where you can prove that this stock is discounted. And if we look at the 1-year chart, see, they haven't been overly bought. They've been kind of flat. United has been rallying lately. So we'll look at the 1-year chart. See how United's gone up nicely, and they did their earnings and they really went up. So it's been really rallying. But I'm not seeing that in Copa. So I'm not going to buy another airline stock, but this one looks interesting. I think this one would probably value well. And if you're comfortable with this business, it's down in Latin America. You know, this might be one that you have an advantage against the market. So you have an advantage as an individual investor in small caps, mid cap stocks, because the big analysts, they're just covering Visa, Alphabet, Amazon. They're covering the big, massive stocks, the most valuable ones, but nobody's really covering Copa. So if you can get the information advantage and buy at the right times, you know, these small stocks could really reward you. I think the travel industry is going to continue to do well, by the way. I think it's a very good industry and it should continue to do well. So, all right. So the next one, Quags. Take a look at CRISPR. Okay. So here. All right. So real quick, just need to check on something. All right, so we're going to look at CRISPR. So do you have a symbol? I'm not finding it. CRISPR. Do you have a symbol, Quags, you can put on there? Cinematographers. Victor, if we head towards downturn markets, you will sell off percentage to protect. No, so that's a good question, right? So let's say, so if you feel like there's going to be a downturn at some point in the next 6 months, you know, the worst time, in my opinion, like if we look at, we're looking at the 5-year S&P, as we start going over the waterfall here, you know, it kind of feels like, hey, I should sell off and kind of go away. And I think in the right, selling the companies that you feel are going to really be hit the worst, is probably a good idea. But just saying, hey, I'm going to sell 80% of my portfolio and wait until it's a better time, that's something I wouldn't do. I would probably select, you know, the weak 20%, sell those off, create some cash, especially right now, put it into bonds, and you know, wait for stocks to, you know, show that they're really well discounted, and go from there. So I wouldn't just sell my whole portfolio, and I would, you know, pick stocks wisely. All right. All right. Next question, AP. Thank you. I bought some bros. It was around 27 a while back, hoping they continue to grow. Yeah. So, Starbucks and Dunkin', I've been buying into Starbucks, FYI. And the reason I'm buying into Starbucks is so I believe that, different there's different types of stocks, right? There's whoever's the best in their industry. I mean, we just saw Visa. They're number one in their category. I don't think anybody would argue. And they're the most valuable company. And you look at Apple, number one in smartphones. And Starbucks is, without argument, the number one coffee restaurant in the US, maybe the world. I think it's the world. So you're getting the number one player. They didn't get to number one because they're, just doing a terrible job and nobody likes them. No, a lot of customers like Starbucks. They like the brand. They like the experience, name recognition, brand recognition. It's all there. And these guys make money. So I go after, some of the leaders. It's a story that's very easy to understand and to be confident about. Starbucks has been the leader, but recently it's been discounted. So I will gladly pay for the best run company in their industry or sector. I'll gladly buy shares at a discount. And Starbucks gets me into the restaurant industry, this is the only stock that I own in restaurants. Restaurants are tough. It's everybody can understand what a McDonald's is, but it's really hard to run a restaurant. And that's why I buy into Starbucks. And Dutch Brothers, I totally get. And you've heard my comments on that. So Shadow Guy, good to see you, man. Thanks for tuning in. I know it's really late where you're at. Are there any tips you can share about how companies try to hide bad finances in their quarterly reports? So this is a good question. The reason why I use free cash flow is that when you look at free cash flow, it's very hard to hide things. The company officers would actually have to do something that could put them in jail potentially to hide things from the cash flow. The cash flow is very clear. This is how much cash we produced. They can't do funny business or as much of it on the statement of cash flows. And this is why Charlie Munger, the great investor that just died, he was Warren Buffett's partner. He only believed in the statement of cash flows. He did not like the income statement because on the income statement, you could have a little bit of shenanigans, like where they maybe recognize a revenue that really isn't revenue or is kind of, not really part of the operations and so forth. So a way of making sure I'm looking at the true value of a company is use free cash flows. So that kind of intercepts a lot of the shenanigans that a bad company might do. So in general, I believe that in the US, companies, most of them, like 99% of them, are reporting their financials accurately. Every once in a while, you get a bad actor, and those bad actors will get found out. And once they do, their officers go to jail. Those companies, implode, and it's a really bad situation. And those examples really teach everybody else that's running a company that you shouldn't do that because you're going to end up in jail. So people are prevented from doing that in the future. Good to have you, Shadow Guy. Again, thank you for tuning in. I know it's really late where you're at. Omar, thanks for showing up, man. Appreciate you. Neil, do you pay tax on your 4% dividend? It depends. Like United is in. So I have a portfolio that's after tax money. It's mainly my income portfolio. If it's in that portfolio, the answer is yes. Most of my dividend income payers, I pay taxes on it. Why is that? It's because I'm trying to set up kind of a very good income portfolio that's going to pay for all my expenses when I retire. And then in my growth portfolio, I have some dividend payers. Like, for example, Meta just started paying a dividend. Well, it's in my growth portfolio. That one is pretty much tax deferred. I don't pay any taxes on the dividend. I just buy additional shares, and that's how I treat my dividends. So most of them I do pay taxes on. And then, okay, Quags, you were asking about CRSP. So CRSP. Okay, CRISPR Therapeutics. So this is a healthcare company, gene editing. Okay. So gene-based medicines and healthcare and biotech is kind of a forgotten sector that has done really well in the past. So I own a number of healthcare companies because I think they're really going to do well going forward. Now, this company had really high stock price, 193. Wow. And now it's down to 51. Okay. Over the last year, we're looking at 50, and it came down recently from 89. Wow. What's going on? So forward P is 23. Not too bad if they're growing. Analysts say it's a buy, and it's discounted by 54%. Wow. Look at this growth. They went from 1 million to 371. Interesting. But why are they going from like 914 to 1 to 371? You see this here? It's going 289 to nothing, 915 to nothing. That is unusual. I'd want to know what's going on here. What's the story behind this business? Why does it go up and down like that? Operating cash flow is negative last 2 years. That's a worry. 21, it was very high. That's good. Okay. What's their market cap? 4.3 billion. All right. And cash flow worries me. The income, right? Why is it not like consistent year over year? I'd want to check that out because that would worry me. Like, what if in 24 they go back to like almost no revenue? You know, the stock's going to crash. The forecast is that they're going to lose money this year. They're going to lose money next year. They're going to lose money until 2027. I think these guys probably are a young company that have a certain set of therapies, drugs that help people, and they haven't been completely proven out. If they make it, they may double, triple in value, if not more, but there's a good chance they're not going to make it. So I really, really understand the company, understand their financials. What happened in those years that there was no revenue? I'd want those questions answered before I could get serious about analyzing that company. All right. Thanks for joining Cinematographers. Random. If there's a recession, how do you spray your portfolio? I don't buy gold. Gold's never made sense to me. I think if we have a recession, it'd be good to go into like boring stocks, consumer staples, stocks that pay dividends, just really safe stocks. That's where the Dow was rising this week. So it may be signaling, hey, we're going to go into a recession. That's what the market's telling us. I'm buying bonds. Bonds are going to pay that interest rate no matter what. And I think they're going to rise in value because if we go into a recession, the Fed's going to lower interest rates. And when they do that, bond values go up. So bonds is a good move. I think we are going to have some type of slow growth in 2024. Interest rates are going to go down. I would say that the Fed is going to need to lower them. Another signal that the recession is either coming or slowdown's coming is employment reports are pointing that, hey, there's more people that are being unemployed and there's fewer jobs out there. And that's beginning to form a recession. So we'll see. I don't think it's going to be bad, but I think we're just slowing down. Random. In Airbnb's financials, I saw that they have a clause saying free cash flow includes future income. This boosts their free cash flow and huge margin. Yeah, I didn't see that. Well, it might be that the free cash flow number, what they might be saying is the way Airbnb works is people say, hey, I want to stay at that property. And it's May, and I'm planning my vacation with, my family in July or August. And it's going to be 3 months before I travel, but I already paid Airbnb a full amount. Well, that is cash flow. And they haven't earned the money and they haven't had you stay at that property. Therefore, it is part of their future income, but they have the cash in hand. Okay. So that's, I think, what that means. It doesn't worry me. It's just their business. Random. Yeah, I just answered that. So that's what happens, especially around like holidays. Like people are already reserving for like Christmas and New Year's. Well, what's advantageous to an Airbnb is, hey, I want to rent that house up in the mountains for Christmas. It's going to be, $3,000 to rent it for a week. here's my money. And they're like, all right, cool. We're going to get to keep your money invested in short-term, bonds, make 5% on the money. And then you stay in the December timeframe. And that's when Airbnb will pay the property owner. And that's when the property owner gets their part of the cash, and they get to keep part of it as in the form of profit. Okay. So good stuff. Sergio, thank you for the reply on HE. But my main question is, if they reported good earnings, why didn't the stock price change? I think because the sentiment, the emotion around this company, investors are too worried. They're like, hey, how big are these lawsuits going to be? And probably what may happen is that Hawaiian Electric is going to have to file bankruptcy. And when they do that, how's it going to affect the stockholders? So it's very hard to see that stock rally until all those lawsuits, till they have like those figured out. Again, the example I'll use is 3M. Once they were able to agree on what the settlement was going to be with all the plaintiffs, and they said, okay, that's going to be the settlement, this is how we're going to pay for it, the stock rallied. It was like, okay, all that worrying, the investors don't need to worry about that. They've put it to rest. So until they put it to rest, I think the stock's going to have a hard time rallying. All right. All right, Sergio. Normally every time. Yeah, it just depends, and some earnings are kind of counterintuitive. Like a company announces, it seems like it's a positive report, but then it sells off. In your case, it's like, it seems like a positive report, but the stock didn't go anywhere. So I'm kind of giving you my best guess. Quag, good to have you. Shadow Guy, thanks for coming on, going off to bed. Yeah, have a good night. Have a nice weekend. And then, yeah, genetic companies, I mean, AI is one thing, but I think just the powerful compute that we have today and the ability to do these huge, computes, these massive, powerful computers enable genetic companies to do far more. And AI is going to be part of it. But I think the whole big data and all this ability from a technology perspective is just going to help them create certain, remedies or, solutions for people that have certain diseases. All right, good stuff. So we covered a lot of ground. Good stuff, everybody. I think I mentioned, the two stocks that I bought were Pfizer and Nike. This weekend, I am going to figure out which stocks I'm going to sell. I'm going to just sell probably some stocks that are the weakest ones in the herd and create a little more cash. And I'll reveal those on the next, live stream. And I'll share with you why. It might be a company that still shows that, hey, it's discounted. It may do well. But I think I need to create a little more cash just to feel like, hey, if correction starts next month, in 3 months, and it really is a good one, I want to have an adequate amount of cash, and that's where I'm moving towards. So I'll share that with you then. And overall, week to week, back to an earlier comment that I covered, which was there's always good stocks to buy, and there's always stocks that I should be getting out of. Whether the stock market's really expensive or it's really sold off, that doesn't change. But the number of companies when the stock market's really expensive that are discounted is really small. It makes it harder to be a value investor. When a market sells off, it's easier. Hey, I would gladly pay this price for Amazon because it's just gone down 60%. That's an easy proposition. So I'm waiting for times to get a lot easier to find just great deals. And we'll see when that happens. It's going to happen. I just don't know if it's going to happen in 2 months or 12 months or when, but it's going to happen. So that's the live stream, everybody. I hope everybody had a successful week investing. It is Mother's Day on Sunday here in the United States. For all the mothers out there, happy Mother's Day. I hope you enjoy a really nice day. And everybody, thanks for tuning in. I really appreciate you joining. I appreciate all your support on all the videos. And last comment, as I always say, is I'm an individual investor. Everything that I cover is just my opinion, and it's for educational purposes. I'm not recommending you buy or sell any company that I cover. Please make your decisions very, very carefully. This is not financial advice. Everybody have a good night and a nice weekend.